future. It's no secret that history repeats itself. And when it comes to the stock market, investors will do whatever mental gymnastics they need. This time it's different. In fact, legendary investor Sir John Templeton. A legendary investor once called those the 4 most expensive words in the English language. And he's right. Because nothing empties a brokerage account faster than blind optimism dressed up as financial genius. Which brings us to Jesse Livermore. Jesse Livermore, who is considered a pioneer of speculative trading in the markets, was the basis for the main character in the best-selling book Reminiscences of a Stock Operator, and is most well known for making his fortunes by shorting markets during crashes. And there's a stock market bubble that nobody talks about anymore. It's a bubble that looks disturbingly similar to the current state of the market. I'm not talking about the dot-com bubble of the early 2000s or the 2008 financial crisis. I'm talking about a bubble. It was a bubble that when it popped, the damage was ugly. The market crashed 50%. Many of the large inflation surged from 3 to 11%, and the stock market didn't fully recover for 8 years. I'm talking about the Nifty 50 bubble of the early 1970s. This was the reality of the Nifty 50 collapse. Investors who thought they were buying eternal growth stock.
The story starts in the late 1960s. The United States has just ridden a 20-year economic sugar high following World War II.
Factories were booming. Suburbs were popping up out of nowhere like acne on a teenager.
And Americans thought the country was invincible. Because in the late 60s, people had money, they had confidence, and why wouldn't they? The United States had just beaten Germany in World War II.
USA! USA!
Dropped a man on the moon, allegedly, and most importantly, invented the Etch-a-Sketch. Life was good.
And in the middle of all this optimism was the stock market. From 1945 all the way to 1970, the United States stock market had this unprecedented bull run led to a new strategy in investing becoming popularized. It was known as investing in one-decision stocks. The concept was simple. Invest in companies so powerful and so dominant that you only had one decision to make when it came to investing in them: buy.
These stocks became known as the Nifty 50. The Nifty 50 wasn't comprised of penny stocks or emerging tech companies.
But it was comprised of blue-chip companies that generated stable cash flows. It was companies like Coca-Cola, American Express. Investors saw these companies as bulletproof, and because of this, the idea of ever selling any of these stocks was considered crazy.
We'll never sell!
Chapter 2. The Bubble.
Here's the thing about investing. If something sounds like a no-brainer investment with zero downside, it's almost always a financial grenade with the pin already pulled. And that was exactly the case here.
By the early 1970s, the Nifty 50 stocks weren't just expensive, they were priced like gravity didn't affect Wall Street. The average PE ratio for the overall market at the time was a humble 15. Respectable, normal, the kind of number you could bring home to your parents. But the never-sell mentality around the Nifty 50 turned their valuations into numbers you only see in a fairy tale. It all came crashing down. The banks had blown up the economy by handing out loans to anyone with a pulse. So following the financial crisis,
Regulators stepped in and said, "It's time we start acting like responsible adults."
These regulators rolled out a whole new rulebook that forced banks to increase capital reserves, cut leverage, and tighten lending standards. This meant that lending to small and medium-sized companies, which were the companies with higher risk profiles, suddenly wasn't worth the headache for traditional banks anymore.
and so by 2010, traditional bank lending to these middle-market companies had plummeted. And now they were in an awkward spot. These middle-market companies were too big for your local community banks and too small to issue bonds on Wall Street. And that's where private credit steps in. Private credit funds stepped in and said, "Don't you worry, the banks may have ghosted you, but we've got you." Forget the collateral. Just sign here, pay 10% interest, and we'll tack on a few fees. And we'll do.
And companies lined up faster than white girls at a Lululemon sale. In 2010,
Private credit assets under management sat around $300 billion. And by 2020, this number had surpassed $1 trillion.
That means since 2007, private credit hasn't just grown, it's exploded more than tenfold.
It's turned from what was once a niche corner of finance into Wall Street's favorite money machine.
Chapter 3. The Goldilocks Asset Class. Smoojo. Over the last 20 years, private credit has returned about 9.6% annually, while over the same period, the stock...
So if private credit has underperformed when compared to the stock market, why are investors drooling over this asset class? And the answer comes down to 2 words.
Two words that make business majors whisper, "This is it, boys."
2 words that make that girl a couple desks over from you say, maybe he's not such a nerd.
2 words that make investors salivate just at the thought. And the 2 words are stable returns.
See, while private credit may trail the stock market by about 60 basis points annually. It delivers those returns without the emotional roller coaster that stocks bring. Stocks can swing 20% up or down in a single year, while private credit, on the other hand, is smooth, boring, and consistent.
And after over a decade of interest rates being garbage, where bonds paid next to nothing, private credit has become the Goldilocks asset.
Too risky for banks, too safe for hedge funds, and just right for anyone managing $30 trillion in other people's money.
It offers pension funds and endowments a place to park their $30 trillion in assets under management.
It's a seemingly perfect middle ground solution, with equity-like returns and bond-like volatility. However, it's not all sunshine and rainbows.
When it comes to private credit, there's no centralized exchange, no liquidity, no public price quotes, and nobody really knows how much these loans are worth until someone stops paying.
There.
But that's the magic of Wall Street. Investors will happily ignore any growing cracks underneath the surface as long as they're getting there. Because the whole private credit industry is run on one assumption: borrowers will keep paying. And to be fair, for the last decade they have.
Or maybe it's not. Maybe it's just the latest bubble wearing a different colored suit. The truth is,
But for now, Wall Street's getting richer. And as long as those interest payments keep rolling in, nobody's going to be asking too many questions. Subscribe for more casual finance.